4 hours. That is all it took. $117 to 102, 13% erased. Billions in paper wealth vaporized between the time markets opened in New York and the time traders in Tokyo poured their morning coffee. If you are watching this, you already know something extraordinary happened in the silver market over the past 12 hours. What you probably do not know is what happened next, and what a Swiss billionaire said about it that should change how you think about everything. Stay with me. This is important. Let me set the scene. Yesterday afternoon, silver broke through $117 an ounce. That is a price level that would have seemed like fantasy 12 months ago. Back then, silver was trading below $30. The idea of a 400% rally was something you would dismiss as delusional. And yet there it was, 117.54, a fresh all-time high, a number that made veteran precious metals traders pause mid-sentence and stare at their terminals. Then the collapse began. In the next 240 minutes, silver shed nearly $15 an ounce. A 13% crash that ranks among the most violent moves in the metals history. Leveraged traders who had been riding the rally suddenly found themselves underwater. Margin calls cascaded. Stop losses triggered more stop losses. Algorithms designed to follow momentum amplified the decline. By the time Asian markets opened, silver was trading at $102. The flash crash headlines were already being written. Silver bubble bursts, precious metals rout, the inevitable correction arrives. Except that is not what happened. This morning, as I prepare this video, silver is trading above $110. It has recovered nearly 80% of the flash crash losses. It is climbing as if yesterday's 13% plunge was nothing more than a speed bump. And this is where the story takes a turn that demands your attention. James Emmett is not a social media personality. He is not a newsletter writer trying to sell subscriptions. He is not a retail investor sharing hot takes on financial forums. James Emmett is the Chief Executive Officer of MKS PAMP. If you are not familiar with that name, you should be. MKS PAMP is one of the largest precious metals refiners on planet Earth. Based in Switzerland, they process billions of dollars worth of gold and silver every year. They operate production facilities across multiple continents. They supply minted products to investors and industrial consumers worldwide. When this man speaks about precious metals demand, he is not speculating. He is describing what his company sees on the production floor every single day. And here is what he told Bloomberg in an interview published just hours ago. Quote, "There is immense silver demand in a way we have really not seen before." End quote. Let those 9 words sink in for a moment. Not in a decade. Not since the silver squeeze of 2021. Not since the Hunt brothers tried to corner the market in 1980. Never. The CEO of one of the world's largest refiners just declared that physical silver demand has entered territory without historical precedent. This statement landed at the exact moment silver was recovering from its flash crash, at the exact moment when bears were preparing victory laps, at the exact moment when sentiment should have been maximally negative. And instead of confirming that the rally was over, Emmett confirmed the opposite. Demand has never been this intense. Now I need to explain why this matters beyond the obvious headline. The flash crash from 117 to 102 was a mechanical event. It was not driven by a fundamental shift in silver's supply and demand dynamics. It was driven by the plumbing of futures markets. When prices move, this fast margin requirements escalate. Exchanges demand more collateral from leveraged traders. Those who cannot meet the calls are forced to liquidate. Their selling triggers more price declines, which triggers more margin calls, which triggers more forced selling. This is the anatomy of a flash crash. Over-leveraged positions unwinding in a cascade. Algorithms amplifying momentum in both directions. Thin liquidity at extreme prices, creating gaps that look catastrophic on charts. But none of this changes the physical market, the actual metal, the bars in vaults, the coins in safes, the industrial ingots waiting for manufacturing. That physical market did not suddenly find more supply yesterday. The structural deficit that has plagued silver for years did not resolve itself in 4 hours. The industrial demand from solar panels and electric vehicles and data centers did not evaporate between lunch and dinner. What happened was a violent repricing of paper contracts. The physical market watched, and then it bought the dip. This is the crucial pattern to understand. Every time silver crashes, physical buyers step in. Every time leveraged speculators get flushed, the fundamental demand remains. Every time the market tries to declare the rally over, the underlying forces push back. And those underlying forces deserve detailed examination because they are unlike anything we've seen in previous silver cycles. Start with industrial demand. Silver is not just a monetary metal that sits in vaults appreciating quietly. It is one of the most versatile industrial inputs on Earth, the best electrical conductor of any element, the most reflective metal known to science, naturally antibacterial, essential for applications ranging from electronics to medicine to renewable energy. The solar industry alone now consumes over 200 million ounces of silver annually. That number has grown at double-digit rates for years. Each new solar installation requires silver paste for the photovoltaic cells. As solar capacity expands globally, silver demand expands with it. Electric vehicles use up to 2 ounces of silver per vehicle in sensors and wiring and battery components. As EV penetration accelerates toward 30%, 40%, 50% of new car sales, silver demand from transportation will continue climbing. Artificial intelligence infrastructure is emerging as a major new demand source. Data centers require silver for high conductivity components, circuit boards and capacitors and connectors. Every new AI training cluster being built by the hyperscalers needs silver to function. Add it together, and industrial demand now accounts for over 55% of annual silver consumption, up from below 40% just a decade ago. More than half of all silver produced each year is consumed in applications that permanently remove it from available supply. This is fundamentally different from investment demand. When investors buy silver coins, they can sell those coins later. The metal returns to the market. But when manufacturers solder silver into circuit boards or seal it into solar panels, that metal is gone. It is consumed. It does not come back. This creates a structural floor under silver prices that did not exist in 1980 or 2011. Even if investment demand collapsed entirely, industrial demand would persist. Factories would still need silver to build the products that modern civilization requires. And right now, investment demand is not collapsing, it is surging. Societe Generale released analysis this week showing that silver ETFs have absorbed 491 tons of net inflows since October. Not retail traders speculating on Reddit, institutional capital, asset managers, pension funds, hedge funds, professional investors building exposure to precious metals. Those ETF flows explain roughly 65% of silver's 130% gain since early autumn. When institutions allocate at this pace, it signals conviction, deliberate strategic positioning, not momentum chasing. Meanwhile, the debasement trade is intensifying across the entire precious metals complex. This requires explanation because it is the single most important theme driving gold and silver prices right now. The debasement trade is what happens when investors lose confidence in fiat currencies and sovereign debt, when they look at government balance sheets drowning in deficits, when they see central banks manipulating interest rates for political convenience, when they watch currencies being printed into worthlessness. Instead of holding bonds that pay negative real yields, they rotate into hard assets, gold, silver, platinum, things that cannot be created by a keystroke at the Federal Reserve, things that have maintained purchasing power across centuries while countless fiat currencies collapsed. This rotation is accelerating because the conditions driving it are accelerating. Consider what is happening with the Federal Reserve right now. President Trump has been conducting what some observers describe as a celebrity apprentice-style search for Jerome Powell's replacement. Powell's term as Fed chair expires in May. The announcement of his successor could come any day. Treasury Secretary Scott Bessent confirmed this month that a decision will be made in January. The two leading candidates represent opposing philosophies. Kevin Hassett serves as director of the National Economic Council. He believes the Fed should cut interest rates aggressively. He has argued that artificial intelligence will boost productivity growth and naturally suppress inflation. A Hassett Fed would likely mean easier monetary policy, a weaker dollar, lower real rates, conditions that historically send precious metals soaring. Kevin Warsh is a former Federal Reserve governor known for hawkish views. He believes monetary policy has been too accommodative. A Warsh Fed would likely mean fewer rate cuts, a stronger dollar, conditions that could pressure gold and silver lower. Markets are pricing in roughly 50-50 odds between these candidates. The announcement itself will move precious metals sharply. 10% moves are possible depending on which direction Trump goes. But here is what makes the current environment unprecedented. The sitting Federal Reserve Chair announced earlier this month that he is under criminal investigation by the Department of Justice. The stated pretext involves renovations at the Fed's headquarters building. But Powell himself framed the investigation differently. He released a video statement saying the probe was driven by the fact that the Fed sets interest rates based on economic conditions rather than the preferences of the president. Read that again. The chair of the Federal Reserve is claiming that the executive branch is investigating him for not cutting rates as fast as the president wants. Whether you believe Powell's characterization or not, the implications for markets are profound. The political independence of the world's most important central bank is under direct assault, and when investors lose confidence in monetary institutions, they flee to hard assets. This is debasement in action, not theoretical debasement, not future debasement. Active ongoing erosion of the norms that underpin the global financial system, and silver is responding accordingly. Now let me layer in another catalyst that most people are missing. Prediction markets are currently assigning roughly 80% probability to a partial federal government shutdown by the end of this week. 80%. That is not a tail risk. That is near certainty. Government shutdowns historically boost safe haven demand. Investors get nervous when the machinery of government seizes up. They reduce exposure to risk assets. They increase exposure to gold and silver. If the shutdown occurs, it adds fuel to a precious metals rally already burning hot. If a last-minute deal is reached, there may be temporary relief selling in gold and silver as shutdown premium gets priced out. Either way, another source of volatility is arriving within days. Let me add one more dimension. China. The Chinese angle on this silver rally is severely underappreciated in Western analysis. Prices in Shanghai are trading at significant premiums to London spot prices. Chinese buyers are paying more than the global benchmark to secure physical metal. They are not doing this because they enjoy overpaying. They are doing this because they believe supply is genuinely constrained, because they want metal in hand rather than paper promises. Reports indicate that Chinese manufacturers have completely pivoted production away from silver jewelry toward investment products. Every ounce of refining capacity has been redirected to bars and rounds and investment-grade ingots. Factories are running at capacity to meet domestic demand that shows no sign of slowing. Furthermore, China implemented new silver export restrictions at the start of 2026. Only 44 companies are now authorized to export refined silver for the next 2 years. While some analysts argue this licensing regime mirrors frameworks that existed previously, the timing matters. When exports are restricted during a period of surging global demand, it tightens supply chains further. India presents similar dynamics. The short squeeze that occurred ahead of Diwali last year was historic. Indian buyers stripped the London market of available inventory. Physical premiums spiked. COMEX warehouse outflows accelerated as metal moved east to meet Asian demand. That demand has not subsided. If anything, it has intensified as prices rise. Indian retail investors view silver as an accessible alternative to gold. As gold prices have broken above $5,000, silver becomes more attractive to buyers who want precious metals exposure without gold's price tag. And this brings me to the fundamental question everyone wants answered. Can this continue? The honest answer is that nobody knows. Anyone claiming certainty in this environment is either lying or foolish. Let me give you the bear case in its strongest form. Silver has gained approximately 260% over the past 12 months. That is an annualized return that almost never sustains. Mean reversion is one of the most reliable forces in markets. What goes up too fast eventually comes down. Marko Kolanovic spent years as chief global strategist at JP Morgan. He recently warned that silver could trade at roughly half current prices by the end of 2026. His argument is straightforward. Parabolic rallies exhaust themselves. The mechanics of 1980 and 2011 will repeat. Prices this extreme are inherently unstable. History offers support for this view. In 1980, silver spiked to $50, then crashed more than 50% within days as margin calls cascaded and speculative excess was purged. In 2011, silver reached $49, then spent more than a decade trading lower. The flash crash from 117 to 102 is exactly the kind of volatility that precedes major trend reversals. If enough weak hands get shaken out, if enough leveraged longs get liquidated, if enough negative headlines accumulate, sentiment can shift. That is the bear case. It is legitimate. It deserves respect. Now let me give you the bull case in its strongest form. The structural demand profile of silver has completely transformed since previous peaks. Industrial consumption at 55% of total demand versus 40% creates a floor that did not previously exist. Solar and EV and AI demand will not disappear if price is correct. Factories will still need silver, regardless of what speculators do. Central bank behavior has shifted. While central banks do not stockpile silver like they stockpile gold, their purchases of gold indirectly support the entire precious metals complex. When gold rallies, silver follows with higher beta. And central bank gold buying shows no sign of slowing. The debasement trade has momentum. Fiscal deficits are not shrinking. Government debt is not declining. The conditions that drive investors out of fiat and into hard assets are intensifying, not resolving. Physical market tightness is genuine. When the CEO of MKS PAMP says demand is unprecedented, he is not engaging in promotional hyperbole. He is describing what his refineries process. And every flash crash that fails to break the underlying bid confirms that physical buyers remain committed. The critical mineral designation by the US government signals policy support that did not exist previously. Domestic production incentives, supply chain security initiatives, potential price floors established by strategic stockpiling. That is the bull case. It is also legitimate. It also deserves respect. Where does the truth lie? Probably somewhere between these extremes. Perhaps silver corrects 30% before resuming higher. Perhaps it consolidates at current levels for months before the next leg. Perhaps the bull case is completely right and we see 150. Perhaps the bear case is right and we see 50. The only certainty is uncertainty. What I can tell you with confidence is that the flash crash did not change the underlying dynamics. It was mechanical, leverage unwinding, paper contracts repricing. The physical market observed and then resumed buying. The recovery confirms that buyers remain committed at these levels. The statement from MKS PAMP confirms that demand is unlike anything the industry has experienced. The catalysts ahead ensure that volatility will persist. Let me give you my framework for navigating this environment. First, accept that this is not a market for the faint of heart. 10% moves can happen in single sessions. If you cannot tolerate drawdowns of that magnitude, you should reduce exposure or exit entirely. Second, separate signal from noise. Short-term volatility is noise. The underlying trends in industrial demand, physical scarcity, and monetary debasement are signal. Focus on what matters over months and years rather than what happens over hours. Third, respect the physical market. Paper contracts can diverge from physical reality temporarily. Futures can be manipulated, but eventually physical supply and demand determine price. When refiners say demand is unprecedented, that is physical market signal. Pay attention. Fourth, monitor the catalysts. Fed chair announcement, government shutdown resolution, China premium levels, COMEX inventory data, margin requirement changes. Any one of these can trigger the next major move. Stay informed. Fifth, maintain humility. The smartest investors I know are the ones who admit what they do not know. Nobody has a reliable model for silver at $100+ because it has never traded here before. Historical precedents offer guidance but not certainty. Finally, remember why you are interested in silver in the first place. If you view it as a speculation on price momentum, you need to accept that momentum can reverse violently. Yesterday proved that. If you view it as a hedge against monetary debasement and fiat currency depreciation, the investment case has not changed. The factors driving that trade are intensifying, not resolving. If you view it as exposure to industrial themes like the energy transition and artificial intelligence, the structural demand story remains intact. Solar installations are not slowing. EV adoption is not reversing. Data center construction is accelerating. Your time horizon and your motivation determine how you should interpret everything I have told you today. The flash crash was real. The recovery was real. The unprecedented demand confirmed by a major refiner is real. The catalysts ahead are real. The uncertainty is also real. What you do with this information depends on who you are and what you are trying to achieve. But whatever you do, stay informed, stay nimble, stay humble, and remember those 9 words from this morning. There is immense silver demand in a way we have really not seen before. When the CEO of one of the largest refiners on earth says that you listen, when he says it on the same day, silver crashes 13% and recovers immediately, you listen even more carefully. Something historic is happening in precious metals markets, something that will be studied and analyzed for decades, something that may reshape how an entire generation thinks about money and value, and the relationship between paper promises and physical reality. You are watching it unfold in real time. The question is not whether it matters. The question is what you are going to do about it.